American investors are stepping into what could be the most consequential week of 2026. Stocks are under visible pressure. The bond market is currently generating far more systemic pressure than the daily stock exchange ticker. Rising Treasury yields are tightening financial conditions throughout the economy, even as share prices fluctuate. It sets the cost of living for ordinary consumers. The Federal Reserve is currently boxed into a very tight corner. They kept the federal funds target range at 3.5 to 3.75% at their July meeting, largely because inflation refuses to drop to their 2% goal. This scale shows the Fed's precarious balancing act. On one side, prices remain heavily elevated. On the other, the labor market is starting to crack, with 23,000 jobs recently lost and unemployment reaching 4.1%. Despite those job losses, inflation fears are still dominating the room. At their last meeting, 3 Fed officials actually voted to raise rates by a quarter point. That internal division makes Federal Reserve Chair Kevin Warsh's upcoming speech at Jackson Hole the critical signal for the market. Investors will use his words to predict the Fed's next move on September 15th. If Warsh signals that rates need to stay higher for longer, borrowing remains expensive, and hiring will likely continue to slow, forcing consumers to carry high interest costs through the end of the year. The Fed's choices are rippling directly into the U.S. Treasury market. The government needs to borrow massive amounts of money, and investors are demanding significantly higher yields to hold that long-term debt. This flowchart traces how government debt becomes a private expense. The yield on a Treasury bond acts as a baseline. When it rises, it drags up the cost of business loans, credit cards, and mortgage rates. By the time these yields reach the end of the pipeline, ordinary borrowers are paying a substantial premium just to finance a home or carry a credit card balance. You might never personally own a government bond, but your financial life is bound to the Treasury market's movements. Beyond the Fed's control, unpredictable shocks in global trade and energy are threatening to upend this delicate math. The United States has recently targeted roughly $20 billion of Canadian imports with a steep 50% tariff, and Canada is threatening retaliation. At the same time, escalating tensions involving Iran are creating severe uncertainty around global energy prices and the future cost of oil. Then there is the corporate wildcard. Nvidia's upcoming earnings report serves as the ultimate proxy for global spending on artificial intelligence infrastructure. If management's outlook on AI demand falters, it could drag down the entire technology sector and the broader S&P 500 along with it. These geopolitical tariffs, volatile energy prices, and tech valuations combine to create direct inflationary shocks that hit consumer expenses immediately. To navigate the coming months, track these 5 signals: Chairman Warsh's tone at Jackson Hole, the incoming inflation data, Nvidia's earnings, Treasury yields, and trade conflicts. These elements form a chain. Interest rates set the floor for bonds, those yields dictate what you pay for a mortgage, and inflation determines how much your paycheck can actually buy. Evaluating these underlying signals provides a clear view of where the U.S. economy is heading, far beyond what daily stock market fluctuations can reveal.